Welcome, everybody. Kelly Slott here, owner and CEO of California Wealth Advisors. Welcome to all of you on Zoom tonight. We are not having in-person tonight. It's only on Zoom. So thank you for attending. I know some of you know me and some of you don't. So I want to welcome everyone. This is part of my Building Foundations for Financial Wealth series. I have a number of these on my website. So go to californiawealthadvisors.com and listen to any of my previous webinars. I have lots of different webinars on there: traditional investments, non-traditional investments, my master proprietary process, lots of different topics. I love to educate. So by all means, go there and look at my previous ones. Tonight, we are going to talk about the keys to a successful retirement. So I'm going to talk about leading up to retirement, in retirement, and beyond. So let's make sure we're actually doing the right things and we're following a good plan, and we've looked at your risk tolerance, your time frame, and we're creating as much income or growth off of your portfolio, whatever it is you're looking for. We're hoping that gets done for you, and that's what we're here to help you with our professional wealth management that we offer. Okay, so I'm going to share my screen here with you all. So this is my series, Building Foundations for Financial Wealth, Keys to a Successful Retirement. Again, I love educating, and just really important for me to get the word out. I really do care about my clients, and I want you to know what's going on with your accounts, and I'll talk about that a little bit later. But I am a radio show host. KNX 1070 is my radio station. I've been on there for 4.5 years. All my previous radio shows are on my website, so you can go listen to there. Each one of them has its own little titling in there, so you can certainly go there and listen to any of those. It's a great way to get to know us here at California Wealth Advisors, what we do, how we do it, and how we help clients. So KNX, it plays on 7 a.m. on Saturday mornings. So if you want to listen there, but you don't have to listen live, you can listen on my most recent radio show is always at the top on the website on the radio show tab. I did write a book, The Great Retirement Mystery: How to Avoid the 6 Biggest Blunders. I want people to avoid the blunders, and I want people to have a great retirement. So what are one of the blunders? Well, who are you listening to? Are you listening to your best friend's sister? And does she really know your whole financial portfolio? Does she know investments? Is she a wealth advisor? Is she a fiduciary? Probably not. So I want you to avoid those 6 biggest blunders. So get my book to read the other ones, and a lot of good information in there. Okay, I want to first talk about your overall financial house and how we look at investing here at California Wealth Advisors, because you do have your investment dollars, and that's important, but that's not the only thing that's important in your overall financial house. So I'm going to stop share here, and I'm going to draw on my little whiteboard here for you. So I position myself for my clients as a financial director, if you will, and that's what will help you in your overall financial house. So of course, there's your investment dollars right here, and then you have the rest of your financial house. So of course, your investment dollars are very, very important, and we do manage that, and I will talk about that in a little bit. But there's also risk to your portfolio. So what do you have in your portfolio that's risky? Well, I talk to a lot of people about taxes. Are you paying too much in taxes? And if you are, what can we do to maybe lower that or minimize that or avoid and delay it? So there's a lot of things we can do. There's a lot of investments we can do or investment programs we can do that will avoid and delay taxes. So every time I've ever seen someone write a check to the IRS, they don't get a check back generally. So I want to lower this for you. I have a client right now I'm working with. He has a $200 million company, and he pays exorbitant taxes every quarter. And I said, well, has your CPA ever said, hey, go talk to someone like California Wealth Advisors that knows how to lower and or delay taxes? And he said, no, my CPA's never told me that. He just gives me a bill. And it's a lot in taxes, as you can imagine, he has to pay. So we're working with him now. So I work with a lot of CPAs to help lower taxes for clients. Another risk to your portfolio is your insurances. So what kind of insurances do you have? Do you have property and casualty? Do you have car insurance? Do you have an umbrella policy? So you need to make sure your insurances cover you enough. And how are your assets titled? If you have titled, I can spell that right. How are your assets titled? Because if you have a rental property and it's titled in your name or your trust name, and somebody hurts themselves on that property and they sue you, they can sue you for not only that property, but all of your assets. And I don't want that to happen to you. So again, I want to protect you and make sure you're doing the right thing for your portfolio and having your assets titled correctly. So there's a number of other risks here. There's long-term care, there's insurance risk. Do you have life insurance? Maybe that's important to you. Maybe you want your beneficiaries to get something when you pass. So all these areas here are very important as far as the risk goes in your overall financial house. Then we go down here to estate planning. So do you have a trust? Do you have the, if I could spell here, T-R-U-S-T, there we go. Do you have trust documents? Do you have medical directives? Do you have powers of attorney? Again, are your assets titled correctly? Let's make sure this is happening for you. And we didn't just forget about it and, oh, we'll work on it later. Let's do it now. It's really important to do now. So estate planning documents are important. I am not an estate planning attorney. I do work with one that I absolutely adore and does a fabulous job for my clients. So I work with many estate planning attorneys to make sure the documents are correct and their accounts are titled correctly. So let's make sure your estate documents are in good order. Then we have over here what we call the family office or the vault. That's where all of your important paperwork goes for your entire financial house. So I put driver's license in here. I put passports many times in here. I put all sorts of statements in here. We do an e-money report that puts all of your assets, whether I'm managing them or not, into one report for you. Very valuable information, especially for your beneficiaries, because if something should happen to you, maybe you and your wife or you and your spouse, your partner, and you're in the hospital, maybe together, unfortunately, your beneficiaries, your kids perhaps, will know to come to us because they can get their medical directive, the power of attorney. We have all the documents. We have the statements. So if you need to write a check to pay your mortgage because you can't do it and you're in the hospital, we have the resources here to do that for you. Again, long-term planning, it's very important to have all these documents and these things set up for yourself now. Don't wait. Now is a good time. So the vault's very important for a lot of our clients. And then, of course, we have your investment dollars here. So, of course, stocks, bonds, mutual funds, real estate, any assets that you own are in your investment dollars. However, it doesn't matter if you have $1 million or $100 million here. Your investment dollars won't matter if you don't have it protected correctly, titled correctly, left to the beneficiaries you want, you have the correct insurances, you're not paying too much in taxes out of your estate. A lot of this goes together in your overall financial house here. So I think it's really important for me to explain this. And I did do a video of this on my California Wealth Advisors site. So it's called the Private Client Process. So please go there and look at that if you want more detail and depth on what I do and how I do it, because I think that's important. Okay, I'm gonna go back to sharing my screen here. Go through the rest of my slides here for today. Okay, so let's see if I can move this out of the way. Okay. Perfect. Okay, so that's my private client process. There's a video of it or a diagram of it there for you. And again, it's on my website, so please go look there and watch that. Okay, let's get into the meat of this seminar. Leading up to retirement, here's some of the things I want you to look at. So if you're not retired yet, or if you're going to retire in the next 5 to 10 years, this is very, very important to you. So let's put the maximum amounts into our 401ks, our IRAs, our SEP IRAs, 457s, 403bs, your pensions account. Maximize those out. By all means, that's how I see people bring me multi-millions of dollars when they get to retirement age, because they kept putting money into these accounts. Whether the market was up or down, didn't matter. They kept putting money in there. That's called dollar cost averaging. Very important to do that. So by all means, keep adding to those accounts. I definitely want you to pay down debt or credit cards once you get into retirement or right before you get into retirement. I don't want you going into retirement with credit card debt. And there are companies out there, if you're heavy into debt and the credit cards, there's companies out there that can help you with that. I want you to create a budget for what you're going to spend in retirement. Now, I want you to create a budget now before you retire, and I want to know what that is. And then I want you to create a budget for what you think you're going to spend in retirement. And I have a budget sheet on my website, so please go there, CaliforniaWealthAdvisors.com, under the Services tab, print out that budget sheet for you. That's one of the first things I ask people when I sit down with them is, first of all, what's your name? And then shake your hand. And then we sit down and we start chatting about, okay, Are you retired? When do you want to retire? Do you have kids? Lots of questions I ask, but one of the first ones is, what's your budget? What are you spending per month? And it doesn't have to be exact, but it certainly can be. I have a lot of people bring me Excel sheets with all of their budget in there, and that's great. So know what your budget is, know what it is, know what I need to manage too. So when you retire, you might say, hey, Kelly, I need $5,000 a month because all my debt is paid. Or you might say, hey, I need $50,000 a month. I have a lot of expenses. Either way is fine. I just need to know what the number is. And then, of course, I need to know what your assets are. So we might want to start moving your assets into more conservative portfolios before you retire. Because again, you don't want to start at $1 million here, and then the market crashes, and then you retire here, and the market's, your portfolio is worth 500,000. We don't want that to happen. So before you retire, usually 1, 2, 3 years before you retire, let's start moving some of those assets into something that's more conservative. We want to consider when to take Social Security too. It's very important. I have a diagram here in a minute. We need to take it at the right time, because Social Security has different time frames that are better than others. And again, it depends on when you're going to retire. So if you don't retire at 62, but you retire at 68, well, don't take it at 62. You don't need it. You have income coming in still, and you get more when you wait. And then, of course, I talked about estate planning documents a minute ago. Have your estate planning documents in order. That means talking to an estate planning attorney that knows what they're doing. I would not recommend using the internet for that. A lot of times, unfortunately, I have heard through my estate planning attorneys that those documents do not hold up in court. We want to make sure your beneficiaries are taken care of. There's no arguing. There's no fighting over anything. So let's make sure your estate planning documents are definitely in order. Okay, so there's 3 phases of your investment life. There's the accumulation stage, the preservation stage, and then the income stage. The accumulation stage, let's say that's age 20 to 50, let's say. We're taking risk. We're buying houses. We're making investments. We're putting money into our 401ks, our IRAs. We're adding to our accounts constantly. That's the accumulation stage, which is great. And that's how I see people, again, bring me that wealth once they retire. However, a year or 2 or 5 before you retire and into retirement, we want to have the preservation stage. We've built up our accounts to $1 million, $5 million, $10 million. We don't want to lose that, so we want to preserve it. So that's why I talked a minute ago about moving some of those investments into something more conservative once you get into retirement or right before you get into retirement. And of course, there's the income stage. When we get to retirement, usually people want me to create income off of their assets, their 401ks, their trust accounts, their IRAs, their pensions. They want me to create income because the paycheck went away. So we've got to what's the word I'm looking for? Recreate the paycheck. So we do that through income from the assets that you have built up at that point. So those 3 stages are very important. And I will tell you that most advisors don't know how to manage through each one of these stages. The accumulation stage, that might be stocks, bonds, and mutual funds. And maybe your big wirehouse advisor is great at that, but they don't know how to preserve it because they just don't offer that. And they certainly don't know how to create income off of that or have the correct diversification either. So let's make sure you're actually doing this correctly for yourself and having a plan for it. Okay, how do we shift from accumulation stage to income stage? Again, it's a different mindset. So moving assets to more conservative income-oriented portfolios, creating that diversification that you should have, and I'll talk about that in a minute. We actually have a strategy for these funds. 9 times out of 10, people bring me their trust accounts, their 401ks, or IRAs, and there's no strategy. They have lots of dollars in there, but there's no overall strategy for any of it. So let's make sure you actually have a strategy for that. And that's what we do here at California Wealth Advisors. And we've been doing that for many years. And we are a fiduciary, and we help hopefully accomplish all of these things for our clients based on their needs, wants, and desires. Okay, this is some statistics here that I think are important. So according to the Bureau of Labor Statistics, only 6% of retirees are financially independent. 40% of those over 65 need to work part-time, and 76 are financially unable to retire at the age of 65. So that's important. So that I keep telling everybody, you need to have a plan. You need to start early. You need to have a plan. You need to have the correct diversification based on your risk, your time frame, everything that's indicative to you, not portfolio A, B, or C that some advisor somewhere told you to do. They're actually looking at your entire financial house. Maybe you want insured products in your overall financial house. Maybe you don't have any now because your advisor doesn't offer them. So again, I want to make sure your total retirement plan, your income plan is taken care of. It's absolutely vital to you and to give you confidence in retirement planning that you can get there, that you can have a happy retirement. I want you to have a happy retirement because that could be a third of your life in retirement. We are living longer. We need to make sure these dollars last that long. So let's make sure we actually have a plan for you for all of this. I want you to avoid those financial mistakes. I don't want you to be too risky in your portfolio. I had a meeting with a client earlier today, and he's close to retirement and he wants me to create income off of his account. But he called me today and he was asking me about Bitcoin. I said, Bitcoin is great and it could make you a lot of money, but there's no income that's created off of any Bitcoin stock that I've seen. They just don't create income, and he needs income because he's getting close to retirement. So we don't want to be too risky in our overall financial plan. We don't want to have a plan because a lot of people have no plan. A lot of people have no strategy either. There's no strategy or plan or diversification in their portfolio. They have stocks, bonds, and mutual funds perhaps, but that's a very small part of the overall financial choices that are available to you. So let's make sure you actually have the correct diversification strategy and plan to your overall financial house. And you know, saving for retirement certainly can be a challenge, and there's different tools we can use. I want you to make sure it's not painful to you when you actually get into retirement, because if you've only had stocks, bonds, and mutual funds and you bought them over time and you accumulated your money there, if the market crashes and then you retire, your dollars are much less. I used my example earlier. If you had $1 million today and you're going to retire tomorrow, but tomorrow the market goes from $1 million to 500,000, well, now I only have 500,000 to create income for you, and maybe you needed that income off of that $1 million. So I don't want that to be painful for you. I want to make sure we're planning this ahead of time and staying away from any crashes that we can see in the market because we've diversified it for your portfolio. Okay, let's talk about diversification. I think this is absolutely key. It really is. I can't emphasize these next couple of slides enough to you. First of all, you want to have a plan. You want to have a plan that's specific to you, not to anybody else, and not portfolio A, B, or C. It's specific to you. I want you to have the correct diversification too. And how I look at diversification is through my master proprietary process: the markets, alternative investments, and safe investments. So here's my diagram of the master proprietary process. So I talk about this a lot on the radio show. I did a webinar just on this, so go look at that if you're interested. Again, on my website, California Wealth Advisors, go check that. So M is the market, A is alternatives, S is safe money. So M being the market, stocks, bonds, and mutual funds. That's usually where I see people bring me money from their 401ks, their pensions, their trust accounts, because that's all that advisor did. And it could have performed perfectly great, and that's great. But when you get closer to retirement, you usually don't want to be 100% in the market. Again, you don't want to go from $1 million to 500,000 in one day. So you want to preserve that. So I look at the alternative side. So that's the A part. So real estate, private placements, oil and gas programs, a lot of times I use. Now, many of those programs have income to them. Some of them have tax advantaged income to them, which is great. And most all of them have some growth component as well. So again, we want to keep up with inflation with anything that we do. So the real estate programs are great. They pay 6, 7, 8%. The private placements are great. I have some that pay 10% right now. Oil and gas programs are great for tax write-offs. And then I have a 10% tax advantage income one right now too. I like these because they don't go up and down with the stock market. When you put money in there and you put in $100,000, your statement's going to show $100,000 until they reprice it at some point. And hopefully it goes up from there. Now, certainly it can go down. There's risk to anything except the S part, the safe money, which I'll talk about in a minute. But I like the alternative side because of the income it can create, the growth it can create, and something different than the stock market. So again, the value is not going up and down with the stock market. And a lot of my clients love that. They appreciate having something that's not 100% in the stock market. And again, I can talk to you about the real estate programs or oil and gas programs we have if you want to chat with me at another time. The S part, so that's the insured part. And when I talk about insured products, I'm talking about annuities, life insurance, long-term care, anything that is backed by an insurance company, insured by an insurance company. We deal with companies that are 100 or 200 years old, so these are not new. But usually the A and the S part of my master proprietary process is what most advisors at the big wirehouses, for instance, are not going to talk to you about because they just don't have selling agreements with them. I will tell you that the endowments out there, the state-run pensions often use the A and the S part as an institution. You as a personal investor might not have heard of them, but the institutions certainly use all three of these sections and have for many, many, many years. So the insurance side is great. I love annuities. I have annuity webinars that I want you to go look at if you're interested in those. Annuities are not good or bad, no matter what you've heard out there. They're not good or bad. It depends on what you're looking for. So I had a client about a year ago come to me with his pension. He brought me about $1 million and he said, I just want income guaranteed for my life and my wife's life. Well, that's the only product I have that will do that. Stocks, bonds, and mutual funds don't guarantee that. Real estate doesn't guarantee that. But I have an insured product that will, backed by an insurance company, guarantee him income for his life and his wife's life. Again, different products suit you in different ways. They have different bells and whistles to them. So I don't usually do all assets in any one of these sections. I usually do some money in each one. But again, it depends on you. I have some clients that like to have no risk, so we're going to do more insured types of products. I have some clients that like risk, so we're going to do some other things. So when I look at the master proprietary process, this is the diversification I'm talking about. I don't want all your assets to be tied up in one thing, like stocks, bonds, and mutual funds, for instance. Now, I use that for the income, and I have a lot of great income stocks that I pick and mutual funds that I pick that pay 6, 7, 8, 10% or more. And that's great. And it's liquid and that's great. But you know, the price is going to go up and down a little bit. Absolutely. So again, when I do all of these sections here, it tends to bring peace of mind and comfort to people because they know they're not so tied to the stock market. Okay, let's do a deep dive here in Social Security. So Social Security, a lot of people think, oh, I turned 62, I should take it. Well, that's the lowest dollar amount you will get if you take it at age 62. Now, if you're still working, I would not recommend taking it at 62 because you're going to get about 8% more every year that you wait. So age 62 is about 75% of your maximum amount you could get. Now, you can wait until you're 70 to take Social Security. That's the latest age. Don't wait until 71. I had a client recently, actually, I was meeting with him and he wasn't a client yet. And he said, I'm 71, I haven't started taking Social Security yet. I said, no, absolutely start taking it because there's no benefit to waiting until, there's no benefit to waiting when you're after age 70. So age 62 to age 70, you get 132% more payment if you wait until age 70. So I highly recommend you do that. You get about 8% more each year. That's a nice rate of return. There's nothing wrong with that. So if you need Social Security, by all means, take it. And if you go to socialsecurity.gov, ssa.gov, you can pull up your Social Security. They take the last 40 quarters, I think it is, of your working career, the highest, I guess I should say. And then they figure out what they would pay you. So will Social Security last? Well, I don't have a crystal ball. I don't know that. But these are the numbers we look at as far as when to take it based on your needs, wants, and desires. Now, a lot of times I do use Social Security as part of that budget. So you tell me I need $5,000 a month and Social Security pays you $2,000 or $3,000 a month. That's great. Well, then I only need to create $2,000 or $3,000 a month off of your portfolio to meet that $5,000 you're looking for. So again, it just depends on what you're looking for, but we take all this into account when we sit and chat with you. Okay. Have you considered long-term care? Long-term care is really important. We're all living longer. 70% of us need long-term care at some point, but only 10% actually have it. So how do we get you long-term care? Well, you can buy a straight long-term care policy, certainly. However, that tends to be pretty expensive. Another way you can do it is if you looked at an old life insurance policy that does not have long-term care, we can exchange that policy. It's called a 1035 exchange. We can exchange that policy into a new policy that actually has long-term care, and that'd be a nice benefit for you. So then you have long-term care that way. You do have to go through underwriting for that. So if you're physically not well, you have diabetes or something, cancer even, you probably wouldn't qualify for a new policy. So another way we do that is to buy an annuity with long-term care. You do not have to go under any of the underwriting for that. And annuities have gotten a lot better over the last few years, I will say. So like I said earlier, annuities are not good or bad. It just depends on what you're looking for. So if you want long-term care, but you wouldn't qualify because of whatever physical issues you might have, or maybe even your age, then maybe doing an annuity that has long-term care attached to it would be very beneficial to you. You can also exchange an old annuity for a new annuity that has long-term care. So if you have an old annuity and it hasn't performed well, or it has fees to it, or there's reasons you don't like it, then we can likely take that and put that into a new annuity that will have a long-term care benefit to it. So again, annuities are not good or bad. It just depends on what you're looking for. And again, if you want long-term care, this is a great way to do it. So talk to me about that if you're interested. So reasons to get long-term care. Well, 1 in 10 of us are the Americans, or I should say the number of Americans who are over age 55 and have long-term care insurance is 1 in 10. So that means 1 person out of 10 actually has insurance. Don't get yourself there. 70% of these 10 people right here are going to need long-term care. Only 1 has it. So let's make sure that we've actually put this in your plan for you somehow, either a straight long-term care policy, life insurance with long-term care, an annuity with long-term care. If you don't have a long-term care policy, then you're going to self-fund. You're going to use your assets to pay for it. And some people do that. Some of my high net worth folks do that, and that's fine. But if you're not that high net worth, or you want to leave more assets to your beneficiaries, having some kind of a long-term care policy might be very beneficial to you. Okay. I don't like people paying taxes. I want you to mitigate as much taxes as you can. And let's ask the question out there, what are you doing to lower your taxes? So some reasons why people need to lower their taxes, or their tax bill, if you will. They're selling their business. I have a client right now I'm working with. He's selling his business for $40 million. He started with nothing. So he's going to get a check actually for $40 million. Good for him. But that's a huge tax bill he'd have to pay if we don't do anything for him. And I'll talk about ways we can avoid that in a minute. But if you're selling a business or any highly appreciated asset, there's things we can do to help you. So don't just pay the taxes. If you're selling a primary residence, you're downsizing, you're moving to another state, you're just going to sell that primary residence. And most of my California folks have really made a lot of money on their primary residence. That's a big tax bill too that you'd have to pay. So what can we do? Again, I'll talk about that in a minute. There are things we can do to avoid and delay taxes there. Again, if you're going to sell any highly appreciated asset, it could be a stock. I have a client that put $200,000 in Apple stock 25 years ago. It's worth $3.5 million today. She wants to sell some of it, but that's a lot of taxes she's going to have to pay. So there are things, again, we can do. Any artwork that you have, jewelry, classic art. I have a client that has let me think about this, a 1962 handmade Ferrari, and he paid $40,000 for it. It's worth $2 or $3 million today. At some point, he's probably going to want to sell it. So that would be a lot of taxes I don't want him to pay. Selling a rental property. If you want to sell a rental property, there's things we can do there as well. We can do 1031 exchanges, or we can do some of the tax write-off programs we have, which I'll talk about in a minute, or right here. So how do we save taxes? So opportunity zones. Now, again, for most of these, you have to be an accredited investor, which means you have $1 million or more of net worth exclusive of your primary place of residence, and you have to be a client of ours. You have to be a client of ours for us to work with you for these. So opportunity zones, that's when you sell a highly appreciated asset. You want to avoid and delay taxes. That is a great source for that. I use that for businesses, the sale of a business. I use it for the sale of primary residences, and I use it for the sale of taxes too, again, or any highly appreciated asset. Now, what's great about the opportunity zones is you can pull out your cost basis of that asset. So let's give an example. So you have a primary place of residence, you paid $1 million for it. It's worth $5 million today, all these years later. You want to sell it, but you don't want to pay taxes on $4 million. So you take that $5 million, you put it in the opportunity zone, you pull out that $1 million cost basis. That's a tax-free withdrawal, by the way. So you can go buy more real estate if you want, or do whatever you want with it. The $4 million goes in the opportunity zone. The taxes are avoided and delayed. It has to be owned for 10 years. That's the definition of an opportunity zone. So it has to be owned for 10 years. After 10 years, the gain on that is tax-free. So it's a great way to avoid and delay taxes and make an asset really work for you. I can get into the details of specific opportunity zone programs if you're interested, but I wanted to kind of bring that up here for you. The other way to avoid and delay taxes is through an intermediate sales trust. And I have trust people I work with specifically for that. So again, my client that's selling his $40 million business, he's going to have a lot of taxes. We're doing actually all of these for him. So intermediate sales trust, whatever money you put in there, there's no taxes. You can avoid and delay taxes for 10 or 20 years. Now, the taxes will be avoided and delayed, which means you have to pay taxes at some point. Sometimes we put life insurance policies in conjunction with the intermediate sales trust. So let's take an example. You have a business and it's worth $10 million today. You started with nothing. You want to take the $10 million, you and your spouse, put the 10 million of that gain into an intermediate sales trust. Now you can use all that $10 million for you and your wife or your spouse or your partner. You can create income off of it if you want. There's no taxes to be paid on that. Whereas if you took that 10 million and put it in the bank, you'd have to pay taxes on $10 million. And that's a lot out of your pocket that you would not be able to use. So it's a way to use all those assets. Now, whatever you take out of the intermediate sales trust will be taxable to you as a withdrawal. But it's a great way to avoid and delay taxes and to use all those assets for your benefit. Again, I can go over this in more detail with you. Actually, I think there's a webinar on my website too that talks about intermediate sales trust. The oil and gas write-off programs, great, I love those. You take $100,000, you put it in one of the oil and gas programs, you get a 90% tax write-off above line 17 on your tax returns. Again, I work with CPAs on this, but if you want to avoid and delay, or if you want to avoid taxes, that's a great program to use for that. My high income people love to use that. Anybody that's sold a highly appreciated asset and they want to avoid taxes, we use it for that as well. And then if you paid the taxes and you want to create tax-free income, we can go to real estate programs. We can go to oil and gas income programs. We can go to municipal bonds. There's different things we can do to then take that asset. If you've already sold it, maybe you hadn't met me yet and you already sold it and the money's in the bank, there's different things we can do to create tax advantaged income for you. So I started this business many years ago and I specialized in municipal bonds, California state and federal tax-free municipal bonds. So I know a lot about the bond market as well. So there's a lot of things we can do here for you. I don't want you to feel like there's no answers. I want you to feel like there's answers for me. I just haven't talked to the right person yet. Again, this is what I bring to the table. This is one of the things I do specialize in, working with people to avoid and delay taxes on any kind of gains that they might have. Okay, remember, it's never too early or too late to begin positioning your portfolio, your money. I want you to protect it. I want you to have it invested correctly. I want you to have the right diversification. If you want downside protection, if you want tax advantages, there's a lot of things we can do for you there. So don't feel like you have to go it alone, because you don't. We're here to help you and create that comprehensive investment plan for you, or look at your total investment house and create the whole situation that's going to work for you. So what we do here at California Wealth Advisors, when we first start the relationship with you, we're going to sit with you, we're going to chat with you about what you have, ask you a lot of questions. If we decide we want to work together after gathering that kind of information, we're going to analyze and evaluate it for you, come back with our recommendations. If you say, great, let's go ahead, we'll implement the recommendations. And then of course, we're going to monitor it regularly with you. About every 6 months or so, we like to sit down with our clients and go, hey, here's your account, here's how it's doing. Do we need to change anything? Now, of course, we monitor things every day, but you don't need to look at it every day. You're in retirement. I want you to collect the income that we're creating for you and go travel the world or do whatever hobby you want to do. So where are you? You ask yourself here, where are you? Are you in the high risk stock, bonds, and mutual funds area? Or are you in the low risk because you're scared of everything and you just got money in cash in the bank or under your pillow or something? You're not earning anything on that. So structuring your portfolio based on your risk tolerance is very important to us. And so we want to make sure we get that right. I do offer a number of beneficial kind of sheets here that you can go to my website, the budget sheet. I mentioned that earlier. Know what your budget is, know what you spend every month. And again, it could be low and it could be high. It doesn't matter. We just want to know what it is so we can manage to that. So again, these are all on my website, CaliforniaWealthAdvisors.com, under the services tab. The asset sheet, if you don't know where all your assets are, this is a great sheet to work out. I have a lot of clients that bring me this sheet when they first meet with me to show me where all their assets are. I think it's important for you to know that and your beneficiaries, but for me to know as well. So the asset sheet is great. And then your bucket list, I want you to think about what you want to do in retirement. What do you want to do? What makes you happy? Start thinking about that. My client I mentioned earlier that's selling his business for $40 million started working when he was 15. He's 65 now. He said, I asked him, what are you going to do when you get this $40 million check? And his eyes got huge. And he said, I don't know. No one's ever asked me that. I said, well, I want you to start thinking about it. What makes you happy? And I have some recommendations on there, or suggestions, I guess I should say. But I want you to come up with your own. And I love it when people bring me this list and they've got their list of things they want to do. I had a client I met with recently and she bought me her list and there was nothing on there but fix the garden, add a new ADV unit. It was all her house. All the 10 things on there was all created to her house, which is great because that makes her happy. She wanted to do that. I have clients that want to travel the world, go on a safari, do all sorts of fun things. So by all means, think about that because I want to create a great retirement for you. Okay, we work with 401ks, certainly in-service transfers when you're still contributing to those 401ks, but you want to have professional wealth management. We can a lot of times move those monies from the 401k into an IRA and manage that for you. Rollover accounts, open a brokerage window, which means you leave the money at the 401k, but now someone like me has access to it and I can manage it for you. Certainly we deal with trust accounts, different kinds of annuities as well, looking at old life insurance policies and improving those. And then, as I mentioned, Social Security as well. Of course, we are a fiduciary. We always have been, we always will be. That means putting your needs before anyone else's. And of course, I want you all to be long-term clients of mine. So I want to do the right thing by you for sure. We are an A+ rated Better Business Bureau company. We're very proud of that. And then we have complimentary services. We do, of course, portfolio reviews. I mentioned we like to do those every 6 months or so. If you need to do a Roth conversion, that could be a great tax a benefit for your overall financial house as well. Cash flow projections, retirement planning, these are all the things that we do. And of course, we have many seminars and client education events throughout the year. Again, go to my events page on my website, sign up for whatever the next event is. I like that first meeting to be in person, that first meeting, because I want to shake your hand. I want to get to know you. I want to make sure we're a good fit. I want you to ask me questions. I want to be asking you questions. I can do Zoom meetings too and phone calls, but I like that first meeting to be in person because I want to get to know you and make sure I'm a good fit with you. So again, thank you for joining us. If you're, again, new to me, call us and make an appointment if you haven't yet. I encourage that. And if you're a client of ours, we love having you on these. I know I hear from many clients to tell me how fun it is to come to the in-person events that we have in the office here. And our summer party and our Christmas party are always really fun too. So if you're a client, you are more than welcome to come to that as well. So again, I want to thank you all for being here, for participating with me in this seminar. If you wrote in any questions, that's great. I will, in the interest of time, I'm going to end the seminar here, but by all means, we'll get back to you with the answers to those questions. So again, thank you for coming. So appreciate it.